Welcome, everyone. My guest today is lead analyst Logan Mohtashami to talk about why rates didn't drop with Friday's negative jobs report and what to expect one day before the election. Logan, welcome to the podcast on this Jobs Friday.
Wow, that was pretty intense. It's Friday morning, and initially that jobs report came in at 12,000. And I encourage everyone, if everyone really needs like a 24/7 kind of like a explanation of what's going on daily, and you can't get our podcast every day, the Instagram account stories, we go over this 24/7. We don't ever stop. So this week, one of the keys that we talked about is key technical levels of the bond market and how the labor data total is going to go. And what's happening is the 10-year yield initially fell and then just spiked right back up to that 4.34 level. We are testing it 2 or 3 times this morning. We haven't been able to break it. But I'm going to try to explain to you why the bond market didn't really care about the jobs data.
Right, because
And
this
even
is the whole
before-
thing, like what we've been talking about. We've been like, okay, watch this data. And I thought if we got it negative that we would see, some good things happen in mortgage rates.
But was it really negative? That's the
This
thing.
is the question. This is what you're going to
This
explain
is the question.
to us.
So before this report came out, I remember I did like a little Halloween video. It might be really tricky tomorrow because of the strike and the hurricanes. But if I take the Boeing equation out and the hurricanes data out, the jobs data for 13 months has been getting softer. Whole theme. I could even show all the data lines getting there. But what it's doing, it's coming straight kind of toward my forecast. And I always talked about, I've been wrong for so long because I was looking for 140 to 165,000 jobs being printed per month. And until the revisions came in, I was always under. Now that the revisions are in, if I take the 12, 6, and 3 month, put them together, average them out, we're like 139,000. So it looks normal to me. The one thing about this week, you have to take all the data as a whole. I'm going to try to explain why the bond market didn't really flinch, and it hasn't really been flinching all week. GDP ran at 3%. I can make a case that you have a one-time aircraft spending just because people wanted to get ahead of the Boeing strike. That'll be a drag in the next quarter. Job openings data, the internals are soft, have been getting softer. That's one of the reasons why the Fed cut 50 basis points. It's one of the reasons why the 10-year yield is not even close to 5%. But when you have a GDP running near 3%, and then you have an economy that's still pushing 4% wage growth, and we highlighted this in the last podcast, wage growth is where the Fed wants it lower. Wage growth is running at 4%. The last few months have been firming up. 4% wage growth, 3% GDP, and with jobless claims falling down to 216,000, the 10-year yield being here isn't that crazy. So just take away the 12,000 number for a second and just imagine all you heard is 4.1% unemployment rate, 4% wage growth, 3% GDP, and jobless claims at 216,000. So if you want to kind of understand why the bond market isn't really like sending yields lower, you take all the data as a whole. The labor market is getting softer, but it is not breaking. Breaking means jobless claims breaks up higher. Now, my argument has always been you want to get ahead of the curve, but I'm not the Federal Reserve. All I have to do is try to model out what I think they're going to do. So we are still going to have another 25 basis cut. We're going to have 25 basis cuts probably until we get down toward neutral. The one area of concern I do have in the labor data is that even if I take the Boeing data out of it, manufacturing data is getting softer. The lack of investments, right? Fed funds rate is still very high. So there's not much investment going on into there. Federal Reserve presidents have talked about this, but they say, well, maybe it's the election. People are holding back on. But now the residential construction jobs are back into play. And we got a little bit of smidge growth, but now that mortgage rates have gone up higher, housing starts and permits are already at recession lows. So those are the two sectors. Those are things that trigger into a recession. And I urge people, forget about talking about the economy, it's strong or soft, think about it as expansion or recession, because I see a lot of people on Instagram, on Twitter, they keep on making the argument, well, the economy, labor is strong. Well, if you think about it in a strong fashion or weak fashion, you're letting your ideological takes go into that. Just think of it as, is it expanding or is it going into recession? If it was going into recession, jobless claims start to rise, 10-year yield will fall. Bond market gets ahead of the Fed. But if you take all the data as a whole together and you just didn't know that was a 12,000 report, I mean, I even think this could get revised even lower next month. This 3, 6, 12-month average on jobs with wage growth at 4%, GDP at 3%, it makes sense in that regard. That's the only way I could explain to you what's going on. And now we're at that key technical level. So my concern is that the internals of the labor market that really start to get to that next level of deterioration are there. We're just taking kind of our time to get to neutral policy or get rates lower. And obviously 6.75% mortgage rates to 7.5%. The builders can't really operate in that. So housing starts are already at recession lows. That becomes a problem. And then manufacturing has 3 months of softer data. So that's my concern with the labor data. But if I look at it, it's near where my average is. And if I look at jobless claims of 216,000, 4.1% unemployment, and 4% wage growth, Fed wants wage growth at 3%, not 4%.
Okay, so let's talk about the Fed because this will be airing on Monday. So not only is it the day before the election, not only are we following Jobs Friday, it is Fed week, right?
The Federal Reserve will cut 25 basis points, and they'll just keep on kind of saying the same thing. They want to kind of get down to neutral policy. And neutral policy makes it not an accommodative policy. That's why I always say that 380 level. I always get this question, wouldn't Fed rate cuts mean mortgage rates go lower? The bond market got ahead of the Federal Reserve and the data didn't get worse. So you'll get rate cuts. If the labor market really starts to deteriorate, there are things that the Federal Reserve can do, and the 10-year yield will go lower. And in a sense, the housing data will get better on that. But it does require jobless. This is why since 2022, we said, do not go to the R word until you see jobless claims heading toward 323,000 on the 4-week moving average and breaking. And that's how economic cycles have worked since World War II. This is why I always tell people, think of it as expansion or recession, because any internal view of the economy, you can let your ideological or financial things take hold. And the data, the bond market isn't agreeing with you, and it gets more frustrating in that regard.
Okay, so you think that when the Federal Reserve cuts by, quarter basis point, half basis point, what did you say? Which one?
It's a quarter, and it doesn't really matter anymore because the market's already priced in so many.
So after the last time, after September 18th, I think, no one in the industry is going to be fooled again because it's like, yeah, we know that's coming, but it's already priced in. So we're not going to worry about that. Tomorrow, when this comes out, tomorrow will be election day. Does the bond market go way up on that day? Does it go way down? What happens?
So this goes into the Trump theory that President Trump would do tariffs and he'll do all these tax cuts and the deficit will blow up, and both those two things together, you have a lot of conservative Wall Street guys say 5% 10-year in that regard. I caution everyone in this backdrop, in 2018 and 19, if everybody looks at the jobs data, I'm showing people the historical data on revisions. We had more negative revisions in 2018-19 than we had recently here. And a lot of that was that the trade war tap dance actually stalled out business investment and the markets were back and forth like crazy. They always have to bring someone out. In this environment, when the economy was running at 3% GDP and the stock market's up big today too, right? It's not the right environment for him to go into that. There's a lot of other things I think has to happen first before he goes into that. So I caution people that let's assume that the 440 level breaks and bond yields go up a little bit higher. The higher rates go, the more problematic it'll be for residential construction, and that's a recessionary data line. This is why I'm not so much concerned about it. If bond yields go up, it just forces more negative data, and that negative data, as we've seen, the Federal Reserve actually state in their conversation, they're not going to react to tariffs with rate hikes because it becomes recessionary. So there's a lot of noise. I would just say once the election's over, then we have a full deck of cards to work with, and then we'll take it from there. But right now, that 10-year yield peaked around 5%. It made one attempt. That downtrend still stayed. It's making another attempt. That downtrend is still in there. Let's cross that bridge once we get there, because for now, it just looks like to me we're still in that downtrend. The labor data is getting softer, just not breaking. And I don't think people are going to risk all that action in the kind of the first or 2 years of a presidency with the state that we're in right now currently.
So you were a loan officer for many years. You were a loan officer when Trump was elected the first time. You were a loan officer when Biden was elected. What is that day like as an originator when especially those two elections, because they're pretty, it wasn't clear what was going to happen, pretty surprising in one case, another really close election. What was it like on those days as an originator?
Well, I mean, I just remember because when Trump got elected, the 10-year yield was at 1.6%, and that was a very, very low level base. So the bond yield just forecasted higher yields because growth, was going to come, and the economy did perform well. That's kind of how I look at it in that regard. We're in a different position right now than then. And a lot of people say, well, if the deficit blew up during COVID and rates were low, right? So there's a lot of things that go into this, and there's a reason why mortgage rates are not at 12, 13, 14, 15%, because the growth rate of inflation is not where it is like it was in the late 70s or early 80s. And we've seen the growth rate of inflation, right? The PCE, the headline number is at 2.1%. The core number is 2.7. So the growth rate of it has slowed down. It takes a lot more than just a hypothetical theory that a sitting president, which Congress actually controls a lot of the budget and spending, can do a lot of things that can move in a very quick fashion. The bond market can overreact on the upside or downside, but it tends to get back into line into where the economy is. And as of now, still this morning, I haven't seen anything that's broken still yet. And I always encourage people, if you guys look at the city economic surprise data, it runs almost 1-to-1 with the 10-year yield and mortgage rates. And the data was getting weaker, and then bond yields fell, mortgage rates fell, and then it got better, bond yields rose. You just kind of want to keep it simple at that. And if something happens where there's big tariffs and inflation, and we'll deal with that until that happens. But it's almost not useful to like sit and speculate on something that did not really occur in 2018 and 19 either as well. So be mindful of any kind of political economic theory, especially this close into the election. What I remember about when Trump won president, so the 10-year yield was at 1.6%. So that was oddly enough, that was the bottom end range of my forecast during the last decade. Actually, I was 3% to 1.6. They were ranging. So my mindset is that, okay, there's not much downside here. If Trump wins, it'll be very pro-growth, pro-investor, and bond yields should rise. What happened was bond yields rose really fast on that day. And I think a lot of loan officers do remember that period in time when Trump won. We're not at 1.6% right now on the 10-year yield. So I remember how frantic it was. I remember I had a client that really had to lock the rates if it went up higher, couldn't purchase the house. So there could be some volatility on the day of the election. Of course, I don't think the election is going to be settled in the first day after. But in that regard, just remember, a lot of it is noise, and bond markets could overreact to the upside or downside, and then things do get back in line. But I just remember that period of time, just for myself, I said, oh, the 10-year yield is at 160. This is there's a lot of upside here, especially if the bond market does think you're going to get a lot of growth, tax cuts, and stuff to that regard.
Well, you're going to be on 3 times this week to walk us through what happens after. So this is going to be live Monday. We're going to have you on Wednesday, and Thursday is your normal day. But who knows what we'll know by Wednesday? We might have some answers.
Yeah, and I still think that just a lot of speculative theory, and by people that are shorting the bond market and just talking their book. And I just encourage everyone, just kind of keep heads up the 440 level on a 10-year yield. And if you really just want to just take a 10-year yield chart, go to 5%, draw a line, crayon economics, just draw that line there. And so if that 440 level doesn't break, then nothing major is going to happen. But to get higher, you really do need more economic growth, more wage growth, more inflation to kind of reaccelerate, because the Fed is trying to get to neutral policy. A bit too slow for my taste, but still, that's still the game plan right now.
I appreciate you being on, walking us through this jobs report, telling us what to look for as the election comes. Really appreciate you, Logan.
It's very confusing. I get it, especially today. I would tell you, it's one of those crazy days where literally people saw the 12,000 reports, and I got tons of messages. Oh my God, 10-year yield's going to go hit the corridor line and everything. Oh, you're wrong. And then all of a sudden it popped up very quickly. Just remember, always take economic data in an aggregate whole, and just close your eyes, take a deep breath, and say this week jobless claims was at 216,000. The economy grew at 3%. We have 4.1% unemployment rate, and wage growth is at 4%. And then, is it really that crazy what's happening today? No. And I'm telling you, the labor data is getting softer on my model, but it's kind of right at that level where I was looking for. Then the next deterioration comes in manufacturing and residential. So those are the two sectors we want to keep an eye on. But take a deep breath. I know it's crazy. Trust me, I get it. If my economist friends are asking me what's going on with the bond market, everyone else is confused. But take it as a whole, and then hopefully that makes sense.
Appreciate that. We will have you on again soon. And I will remind our listeners that every morning, Logan updates our mortgage rate center with where he thinks pricing is going to go. And so if you want to catch that daily, you can see what he's doing. And of course, he's very active on social. So
and you're already in your Thanksgiving mode. You got the fireplace back there. You got the orange backdrop. I still only have Jack behind me, so you're beating me on the holiday theme already. But I'm going to put my Christmas tree up today. And usually I have some crazy outfits that I wear for Christmas. So I'm getting in the spirit as soon as possible.
Getting in the spirit. Yes, I'm at my sister's house. I can't claim this beautiful fire and fireplace, but yes, it's going to be great. Logan, thanks as always. Appreciate you.
Pleasure.